Sell puts for income. Sell puts for income. I like it. Personally, myself, I love selling puts for income. I've been doing it for a long time. And ladies and gentlemen, sales equals income. So you want to make more money? Sell more. And maybe you're saying, Brent, no, I don't like sales. I don't like sales. Well, you know what? I have some great news for you. You can be at home alone, just tapping on your keyboard, clicking on your mouse, maybe doing some math on your calculator. That's all that you really need to sell puts for income. It's a really fantastic thing. Now, some people have told me too that they can't sell something they don't believe in. They got to believe in the product they're selling. Well, if you don't even know what a put option is, how can you believe in it? So let me explain it to you. See if you can, if it's something that you could get, kind of believe in, that might be good for whatever the marketplace, and you can make your decision. If it's something that you want to do, you want to make some income selling put options. Let's see. So what is a put option? A put option is a legal contract that gives the buyer of the put option the right to sell an asset at a specific price, which is called a strike price, in a specific time frame, which we will call the expiration period. The seller of the put option has the legal obligation to fulfill the contract if called upon, and the buyer pays the seller for this. This is very similar to car insurance. At the beginning of your whatever length you buy your car insurance at, let's say 1 month. At the beginning of the month, you, the put option buyer, pays the put option seller, your car insurance company, a premium at the beginning of the month to be there in order to buy your asset, the car, for a specific price, which would be all your little whatever, all these things that you're getting in your insurance for a specific time frame. In this case, 1 month. And then the buyer, you pay the seller for this, right? You pay $100 up front. The seller, the car insurance company, has the legal obligation to fulfill this contract if the certain conditions are met. And that is very similar to what's happening with a put option. Can you believe that? You could be a stock insurance salesperson by just clicking some buttons. It kind of is that simple. So there's 3 basic ways to sell a put option for income. Now, I said 3 basic. I didn't say there's only 3. I said there's 3 basic ways. And so let's get into it. So the first basic way is to sell a cash secured put option. The second basic way is sell a naked or margined put option. This actually could be broken up into 2, but for simplicity, we're lumping them together at the moment. The third one that we're going to talk about is selling put credit spreads. Does this sound like a bunch of gobbledygook? Were you just thinking, Brent, what is this stuff? Well, you know what? I'm glad you asked that question, because I just happen to have some slides answering this. First one we'll talk about, cash secured put options. Cash secured put options are when you have the money to purchase the asset you made the commitment to purchase. Oh my God. I mean, is that mind-blowing? I mean, think about this for a second. You make a legal commitment to somebody else saying that you will buy something at a certain price in a certain time frame, and you actually have the money to do it. You might be scratching your head thinking, well, why would I make that commitment if I didn't have the money? Yeah, I mean, that's a great question, but it's possible to do it in the stock market. So with the cash secured put option, you have the ability to do it. Now, you might be thinking, Brent, I know a lot of people that go around in the world making commitments that they don't have the ability to keep, and even if they did, they're not trying to keep them. That's true. Those are different prices that need to be paid. But in the stock market, they're financial prices that are paid. Those are something for a different video. But the cash secured put option, it's when you have the money to buy the asset that you're selling this a put option, like asset insurance on. This is a great way to buy stock at a discount. Let's say you want to buy a stock that's trading around 20 bucks. Well, you could sell a cash secured put option on it at $18 and potentially be able to buy this asset at a bit of a discount. And if you don't, if it doesn't drop down below 18, if you don't get to buy it at 18, you're still bringing money in. So in a way, you win no matter what. I love this strategy. This is my bread and butter strategy. Now, I do other strategies too, but I absolutely love this strategy because in my mind, when I sell a cash secured put option on a stock that I wouldn't mind owning the rest of my life if I had to, and one thing that I need for that stock pays a dividend. If I'm selling a cash secured put option on a stock that I wouldn't mind owning the rest of my life if I had to, and I'm buying it at a price that I feel is a fair price, is comfortable for me, then at the end of the expiration period, one of two things happens, and I'm happy with either one. One thing that might happen is I don't buy the stock, but I keep the money that I was paid. I keep that money that was paid to me. Just like the car insurance, right? You don't crash your car, they still keep the money. So that's one thing. The other thing that would happen is I keep the money and I buy the stock that I'm okay with owning the rest of my life anyways. And then we go into a different segment of like the next step of the strategy. So either way, at the end of the expiration period, I don't care what happens. I'm comfortable either way. And to me, that is a very, very powerful position to be in because that makes it great for busy people and it makes it great for beginners. Imagine that. You're trading in the stock market. In this particular strategy, when you set it up right, no matter what happens, assuming the company doesn't go bankrupt, right? That's our one little caveat. But other than that, no matter what happens, you win. So this is one of my favorite strategies, something that I do all the time, great for beginners. And let's talk about something that's not so great for beginners, has a little more risk. Naked or margined put options, right? Naked put option. Now, don't get excited, guys. I know you probably heard the word naked. You're ready to take off your clothes and jump into bed and all this stuff. We're talking about a different type of naked. Keep your clothes on, simmer down. Naked put option means you do not have the money to fulfill the obligation you made. And you might be saying, Brent, we were talking about those people earlier. There's a lot of people out there like that. A guy down the road, he's doing that all the time, making all these obligations, and he can't follow through with his commitments. Well, again, in the stock market, you pay a different price. Social wise, you pay a different price. But here in the stock market, you could lose money. So when you don't have the money to fulfill the obligation, you could still write that. You could still sell that into the marketplace. And as long as those certain conditions aren't there, it's kind of like if you sell car insurance, you don't have the money to fix someone's car. And as long as they don't crash, you're okay. As long as they don't crash, you're bringing in money. So you're hoping this doesn't crash. Because if it does crash, then you're kind of screwed. That's basically selling naked put options. Margin put option is a little bit different. When you sell a margin put option, you're using broker margin money to purchase the asset. Your broker might give you a margin account, and that's kind of like a line of credit. However, the one way that it's different than like a credit card is that your margin account in your trading brokerage can fluctuate every day based on some different variables. So, in my opinion, between these two, this is actually the most risky one, because it gives you some false sense of security. You look at your total buying power, how much stock you could buy. You see, okay, I can buy $20,000 worth of stock, but that's with the margin. So let's say you can really only have $10,000 of cash in your account, but because the broker is allowing you to have also another 10 of margin, then you write $20,000 worth of put options. You feel like you can cover this, and then the stock market starts dropping like it has been doing lately, and then your margin amount starts shrinking. So all of a sudden you're buying stock on margin money, and if that asset keeps going down, it's probably getting overcomplicated in this kind of beginner explanation. But just trust me, there's a lot of moving parts in there. So both of these, especially this one, requires way more skill to manage this type of stuff. You can lose money fast and easily. Think about that again. Think about someone who has, think about Geico. Let's say they don't have the money to insure these cars, but as long as people don't crash, they're okay. If they get a couple people crashing, then they have a problem. That is kind of similar to when you're working with, it is very similar to naked. Margin, a little more complicated, and because it seems like you have this money to work with, and because that margin amount can change so quickly, it's sort of difficult to kind of forecast of where that will be under different situations. So because of these things, this is not a beginner-friendly approach, not beginner-friendly at all. In fact, if you're busy, even if you're not a beginner, if you have a pretty busy life, I would stay away from these. These are a little more advanced when you have more time and you have more skill to be kind of sitting there in case you have to manage things. The last thing we're going to talk about is put credit spreads. Now, put credit spread, this probably sounds like super confusing. So put credit spread is selling a put option for a certain amount of money and then buying another one in the same expiration date, but at two different strike prices for less than the amount of money you took in from selling one. So you are selling an obligation into the market. You are simultaneously buying an obligation from someone else at the same time, and both contracts are going to expire at the same time. The one that you're selling, you need to make enough money to have money left over after you pay for this one. This is sort of like making a synthetic cash secured put option. You're basically buying some protection. And so because you're buying the protection, it limits the amount of money you can lose. It is known as a defined risk trade. You know before going into it what your downside is and your upside, but it's defined risk. It limits the amount of money you can lose. The amount of money you can lose is going to be this promise that you made, and then whatever the difference between where you bought your own insurance on your promise, whatever that difference is, that's the amount of money that you have to pay. If you're a beginner, it probably seems super confusing. So what does that mean? It means don't do this. Do something that makes sense. Do something that you can grasp. Why would people do this though? Okay, because it limits the amount of money you can lose, and it also allows you to sell more contracts. There's something called buying power, and we're not going to really get into it too much, but just realize that different positions, depending on how much risk you have, can give you more, can take more buying power, right? The riskier the position, the more buying power it might take to try, it's trying to help you to keep from losing all your money. So with defined risk trades like put credit spreads, you can put on more contracts. So when you know what you're doing, you're able to get a higher ROI. You're able to make more money with this. However, if you don't know what you're doing, you can run into problems. These are riskier than cash secured put options. As I explained, if you sell a cash secured put option on a stock that you wouldn't mind buying and owning the rest of your life anyways, then it's like at the end of that contract period, you don't really care what happens. You're in a good position. At the end of the contract period with a put credit spread, you either make some money or lose some money. You might break even, but you either make money or you don't, and potentially lose money. However, that amount of money that you could lose is known before you go into the trade. So they're riskier than cash secured put options, and they have less risk than naked or M. And what is M? M is for margin. Where's the rest of it? I don't know. So let me just get off the slide just so I can bypass the fact that everyone saw me make a mistake, huh? And let's just look at some examples. Let's get right into the meat and potatoes of this. Now, right now, we are looking at S&P 500, which as of June 1st, 2022, closed at $409.59. These numbers that you see here, right? That is where the stock could be trading. This little round thing here, that is showing you exactly where it's at. And then this is kind of like like a probable amount that it could move in a certain amount of time, and these lines indicate that also. So obviously the further you go either up and down, the less likely that might happen just on these different statistics, right? And here we got short put option. So the first thing we'll look at is just selling a put option. And so right now we're set up. Here's our put option. It's going to expire in 16 days. And what number do we want to sell it at? Let's go down to this line, which is considerably a ways away from the current trading price. Now we're at this line. We look over here. This is probability of profit, and this is telling us that based on the conditions of today, that there is a 98% chance that this option will expire worthless in 16 days. Now that doesn't guarantee it, and it still has a 2% chance of dropping. One thing that you don't want to do when you're doing this is you don't want to rely on this so much that you end up losing money. I've done that before. You know what? You know, sometimes that 2% comes up at the most inconvenient time for you. So just realize that it's a low probability, but it's still a possibility. And we look over here. What is our max risk for this? Well, the stock is trading at, right here, we are basically saying that we will buy this asset at $365. And we are willing to do that in a 16-day time period. And we are going to get paid 49 cents to do that. Now here's a little kicker to this. Everything that we're doing with stocks, with options, we're doing it in increments of 100. So instead of having our max loss be $365, it's times 100. So we're committing to buy 100 shares of the stock at $365, which means that if we have over $36,451 in our account, if we have over that, then we would be selling a cash secured put option, right? Cash secured put option. What did that mean? It means that we have the money to fulfill the commitment that we are promising into the market. So if we have, let's say, $40,000 in our account, then we, with what we're setting up here, we would be selling a cash secured put option. Now, if we have less than $40,000 in our account, let's say we have $10,000 in our account. If we have $10,000 in our account, we are not selling a cash secured put option. We could be doing the exact same thing, but it went from cash secured to not cash secured. Now, let's say we have no margin. Then if we have no margin, then we are selling a naked option. We are on the hook for $36,451, and we only have 10. But we can potentially still sell this into the market. And that's the naked put option. High risk, right? Because if even though there's only a 2% chance that we might have to do that, given everything that we're looking at today, it's still a chance. And sometimes these chances come true when you least need it. Now, if we have margin in our account, right? Let's say if we have $20,000 in our account, we still don't have enough to fulfill this. But let's say we ask our broker, hey, will you give us a margin account? And the broker says, yes. You got $20,000. I will give you a margin account, double of the cash that you have in your account. So I will give you another 20. Now you have 40, right? So now we think that we have the buying power to cover this commitment, right? 20 from us, 20 that's kind of on a loan. So we have 40. So then that would be a margined put option. Now, as I mentioned though, that margin amount changes. Let's say we sell this initially for 16 days, but let's say all of a sudden, let's say you don't have car insurance, your car breaks down, and you got to buy a new one. So you take out $10,000 out of your brokerage account, and now you're down to 10. Now your margin just moved out. Now you don't have enough money to fulfill it. You know, there's all these ways that margin changes. So it takes a higher skill level to be able to do that. All right, does that make sense then? We got cash secured, means that we have enough money to fulfill this in our account, our own money. Naked means we don't have enough money in our account. with margin, without margin, whatever. We don't have enough money. Margined put option means with our cash and margin from the broker, we could fulfill that. So the last one that we were talking about is put credit spreads. Now here it's going to say put vertical, but it's the same thing. So now we're going to sell the same put option, but now we're also buying. We're buying another put option. Same expiration date, 2 different strike prices. The amount of money we could lose, look at that, drastically different, right? We could only lose a little bit less than $800 because we bought this protection here. Let's delete this for a second. Now, if we're just selling the cash, or just selling the put option, we're going to bring in $49. Why is that 49? Because it's in increments of 100, right? 49 cents times 100 brings in $49. Now, if we add, when we do this, right, we still bring in the amount of money from selling this, but now we're also buying this. So once we buy this, we got 20 bucks left over. Then we can change this to whatever we need to change it to. So those are 3 basic ways that we could be selling put options into the market for income. Regardless if you're going to be selling put options, which I think you should. I think you should. Even if you don't want to master the stock market, I think you should be selling put options. I think you should be selling cash secured put options. If it's something that you want to learn a little more about, then there will be a link to a video specifically on selling cash secured put options for income. Watch that, you get a better idea of it. Regardless of what you're going to do, you're investing in real estate, you're whatever it is. Check this out. 3 underused tactics to transform your financial results. These tactics, there's 3 different tactics. They have increasing level of difficulty, and any of them you apply will change your financial results. They're not easy, but the benefits are there. So it's up to you to implement them. Go to iamsuccess.com, get your copy of that, see if it's something interesting for you. And you guys have a fantastic day, and I'll talk to you later.